Kelly Weber with the Bergen Realty team here, and I'm back again with Mike Lamparillo and DJ Tirelli. I can't thank you guys enough.
Thanks for having us, Kel.
Anytime. Listen, I'm just putting it out there. It's a snow day. So what a great day to talk about student loans and COVID qualifications, how COVID is affecting loan qualifications, right? That's exactly.
Those two are exactly correct.
So I'll let you guys take it away. So talk to me about student loans and buyers out there today.
Well, first, what we do is, as part of the pre-qual process for your realtors, as you know, when DJ, puts together a pre-qualification, one of the first things we look at, of course, the credit report. Okay.
Right.
We want to know about income, which we're going to get into, but the credit report's very, very critical. And of course, the 25 to 35 something people have student loan debt.
Yeah.
And believe it or not, the parents do too. So we really deal with student loan debt. We're going to talk about whether it's co-signed, not co-signed, and all that stuff. That's all very important too.
Good.
But let's start with student loans and what we do to qualify. Okay. There's a couple of different instances and ways student loans are reported. Sometimes they're deferred. Okay. Sometimes they're all set up and they're amortizing fully and the payments are being made, and that is listed on the credit report. But what I'm finding is so many more times than not, there's just a big number and no payment because they're either deferred or whatever the situation is. So what we do in that case, this is a simple calculation, and I'm going to talk about how it affects the three types of mortgages. And when I say three or four, FHA and VA, as well as Fannie Mae and Freddie Mac, that most of you know are both conventional, okay? But they have different ways of looking at student loans and how to qualify the debt, okay? So having said that, if you have a student loan and the monthly payment is reported on the credit report, that's usually, and I say usually, what we use, okay? Okay. The next step is the deferred loans, and you see someone has 40, 50,000 in deferred loans. Well, how do you quantify that from a financial calculation? There's two ways. One way is we take 1% of the gross amount. So in other words, let's just use 50,000. If the buyer has 50,000 in student debts and they're deferred, we take 1% of that 50,000, which is $500, right? And we apply that to their monthly payment.
Okay.
That's in the guidelines. So it's not like we came up with this number. This is a Fannie Mae guideline. FHA and VA follow suit. Okay. So for a Fannie Mae, FHA, or VA loan, you're going to have 1% of that amount calculated.
If it's deferred. If it's deferred,
correct. And if it's not deferred, it's there already. The payment is, 200, 500, 100, whatever it is, and we use that number for calculation. Okay. Mm-hmm. Now, the trick is, and a lot of people don't even know this, even in the mortgage business, that Freddie Mac is an alternative way to qualify against Fannie. People think they're the same, and I guess by about 90% they are, but they do have 10% difference in guidelines. Okay. Freddie Mac will take that same deferred loan and only use 0.5% against qualifications. So David and I have had this instance where we've had clients with student loans, and I says, well, listen, we're gonna qualify it, lock it, and qualify it Freddie Mac versus Fannie Mae because we can get away with half of that payment. Mm-hmm. Okay, so realistically, that really knowing that little trick has helped us out in many
getting
occasions.
Pre-approvals. Absolutely, right, that makes sense.
Right. Yeah. So that's something that just knowing about that's important. Now, if you look at qualifications and you look at student loans, a lot of times and it's a shame, it's very difficult. These loans are sold and traded and packaged, and you look at a credit report and you've got a plethora of loans, and the client says, well, I only have $30,000 in loans, and I'm looking at 60 or 70. Because the way when they're consolidated, or when they start out at one number and they grow to another number, which also happens frequently, as all you parents know that have sent their kids to college, it becomes a challenge, really breaking it down and coming down to exactly where we are. And when David and I, not all the time, but when David has a case that has a lot of, twists and turns to it, he brings it to me and we look at it together and you really have to go through that. And sometimes, realtors like, look, I want a pre-approval, and that's great. But until we work out, we do true pre-approvals and advisors where we really make sure, that the client qualifies, and we check all our sources and avenues to figure that out.
Let me ask you something else too. A lot of times, like say they have a $30,000 student loan and it's showing up as 60, and like you said, when it's packaged and sold, could it be it's 60,000 because they didn't release the 30?
No.
Okay,
exactly.
Yeah, okay,
that's exactly what I meant. I'm sorry.
Okay, yeah,
Yep.
So if it's sold 3 times, it could be 90,000, but they're not releasing it. Okay.
Well, what usually happens is, and again, I see these all the time. These loans start out at $10,000, and then before you know it, it's a $10,000, and then they have $20,000 on the loan, which also doesn't help their credit report, which is another issue. But that, and then you have them; they get consolidated, and sometimes they're sold, but most of the time they're consolidated. And you're right; the others are not taken off.
Gotcha.
So my advice for anybody with student loans, whether it's parents or kids, okay, to really keep track of what you have. And when you come to your lender, I would have prepared what you really truly have outstanding in student loans, because the credit reports in that case, I think a lot of times, and I don't want to say more times than not, but way too many more times than I'd like to see, are not correct and accurate with reference to the student loan.
So that's great advice. So make sure you keep track of when they're sold and what you actually owe on these loans.
Exactly. Now, there's another very nice feature for qualification. And I'm going to say this is for all 4 agencies, but I'm going to have to double check that. Okay, please?
Okay.
But let's assume, and I have this case right now where, dad co-signed for the daughter and dad's making the payments on the student loan. Okay, so the student loans are showing up on the daughter's credit report who's buying a house, but yet dad's making the payments. And this is a nice one. If we can prove that dad's made 12 payments out of his account, not a joint account, but out of his own account, we can negate that payment from the qualification. Wow. And we can do it with auto loans too. Not that this is an auto loan conversation, but these are the type of things that we look at when David and I are qualifying a client and their ratios are high. We look to find different ways to make it work, and these are the kind of tools and information we use to make these kind of deals work.
Well, this is why I love working with you guys, because this is the things that you guys do to get people qualified. And I know when I get a pre-approval from you, they're truly pre-approved. That you guys did the due diligence and that we're going to get to the closing table, which is really nice.
And more importantly, too, the clients understand. When we're talking about this, and what happens is, and you've been in this business a long time, you don't do this up front, Kel. A month down the road, you're getting, now you can't get the approval. There's a problem. You got to go this. Nobody wants that. So we, like I said, try and inform the clients too of what's what.
Right. We don't work with people that aren't pre-approved. We just, I learned early on in my career that, you're running around with it like a chicken without a head, and to find out that these people can't get a loan. So everybody needs to be pre-approved. Let's talk quickly about COVID and COVID qualifications. We're still in COVID, so let's talk about it.
Wow.
Yeah.
Okay, where do I begin? Okay, let's go back 9 months. Okay, let's go back to when COVID happened. When COVID happened, the world stopped. Not just my business. Everyone was like, what's going on here? Okay, we all were in a state of flux. Nobody knew what was happening, nor did the banks. We may want to touch on the forbearance too, but let's talk about qualifications right now. And the forbearances that were given out do factor into qualifications, and I'll talk about that. But let's talk about how income is qualified through COVID. And I'll tell you, there's certain, and I'm going to say it the only way I could say it, there are a certain section of borrowers that really got screwed, okay, with the way we have to qualify. And let me give you an example. If you're a wage earner and you have a base salary and you were laid off 3, 4, 5 months for COVID, and then you come back to work, we're allowing, this is the good part, we're allowing you 100% of your base pay. The fact that you missed 3, 4, 5 months is out the door as long as you're established and working
and back up and running
full time.
Mm-hmm.
These, your back part-time things, no good. You can't use the income at all. You either have to be work full-time or we can't use it. That's number one. That's the good part. Okay, now I'm going to get to the bad part. People that are either A, self-employed, B, on commission, and or overtime and bonus. You guys are getting hammered, okay? And I'm sorry to say that. I have cases right now. And let's talk about the self-employed guy first, okay? Now, the self-employed guy, we are not only, because now we're in 220, okay? We only get tax returns for 18 and 19. How do we know what's happened to them in 220? Well, we're going to do a little bit of digging to make sure that their business is still viable and still making money. So what we're doing is, up until days ago, we were taking 2 months of bank statements, business, to show that he has about the same amount of money coming in that he did before COVID.
Okay.
They just evaluated that and switched to 3 months.
Oh gosh. Okay.
Yeah, I know. So now that self-employed guy has to show, he has to provide a P&L from himself, not a certified from the accountant. He's got to provide a year-to-date P&L. Now we're at the end of the year, but this happened for the last 6 months now.
Right,
So
right.
Dealing with it. We has to provide a P&L to show that his revenue is at par with where he was at.
Prior.
Okay, right? His revenue now, we know that, like restaurant owners, we know a lot of them were closed. So we're not going to take that. But what they do is they're going to average out those months that were missed, where income did not come in, and they're going to hold it against you. Okay, that's going to go into the total calculation. So a self-employed guy has to show bank statements now, income in his business, to confirm that he's making the kind of money he was making 18 and
Prior.
Right.
Wow.
Okay. Did that answer? Is that good for self-employed, Kel? Did you get that?
Yeah, that's great. I do get it. I totally understand it. It's a shame, especially
It's a
those
shame.
are the people that can't take advantage of the low interest rates.
And let me continue. Okay.
Okay.
The other clients with base incomes, overtime, bonus, and commissions, right? We will also not hold against them the fact that they were out of work. But when they come back, their overtime bonus and or commission has to be brought back to where it was. Now,
Prior to COVID.
when we average out the income on this wage earner now with this variable income on top of their base, they're going to average in the months that were missed. So if you have a person making just an easy number, let's say $1,000 a month in overtime, and they miss 5 months due to COVID, but we're going to take out the 5 months and we're going to average everything out by 12, not by 7. So they lose, that numeric number comes down. Whenever you hear a bank has to average something out, that means you're getting less qualification, what we like to call allowable income. Qualification in that regard. So that's a big factor with COVID right now. And we're finding clients coming back to work maybe, 30 hours. They're not giving any income at all for those guys that are just kind of dipping their toe in. So the banks are being very, very cautious about lending to COVID clients to make sure they're reestablished, but they're also taking away certain amounts of income from them, making it more difficult to qualify for those variable incomes.
Which is a shame.
Horrible.
On one point, it's horrible, but on the other hand, we don't look what happened in 2007. So we also don't. I can't blame the banks to a degree, but it's also not fair to these business owners. So, well, you guys gave us a lot of great stuff today, and we need to get back to doing this on a regular basis because there's so many things we could talk about. But I want to thank you both on the snow day, taking time out of your day to talk to me. And DJ, it's really good seeing you.
Thanks for having us on, Cal.
I appreciate everything you both do for us and for our team. So thank you very much.
Well, Kelly, thank you too. It's always nice to talk to you and your clients to help them, through the path to homeownership through financing.
Well, thank you both and enjoy the rest of your day.
Take care.
Bye,
All right,
Kel.
take care. Bye-bye.
Yeah.